welcome now one of the leaders in the area. He is Mike Arougheti, CEO of Ares Management. So Mike, thank you so much. Welcome to Wall Street Week. Great to have you here.
Thank you very much.
We hear so much about private credit these days and how big it is, how big it's gotten. Give us your sense of just how big it is right now and why it's gotten this big.
So when we talk about private credit, let me just zoom out quickly. We're talking about lending that is happening outside of the banking system, and that could be in corporate, real estate, infrastructure, consumer. I think a lot of the recent dialogue that folks are paying attention to is more along the opportunity in corporate lending. That's the most evolved and the most developed market, both here in the US and globally. In terms of sizing, no one quite knows, just because a lot of this is in private hands, but order of magnitude, the private credit market for corporates in the US is about $1 trillion. Juxtapose that with C&I loans in the banking system, that's about 2 to 2.5 times that, and almost at parity in terms of size with the leveraged loan and high yield market.
So what effect is the increased interest rates had on the private credit business? Obviously, it's affecting a lot of business right now. It's harder to get loans. If you can get them at all, they're more expensive.
Yeah, I think private credit has tended to outperform when rates are going up for two main reasons. Number one, the structure of the loans are short duration and floating rate, so they typically reprice every 30 to 90 days. So as rates are going up, the return is going up. That obviously in an environment where we're seeing a lot of volatility in the equity markets and valuations are challenged in the high grade markets, private credit is a place where people can actually go to benefit from rising rates. The flip side of that, obviously, is that as rates are going up, debt service becomes more challenging for leveraged borrowers. And so part of the conversation today is, as you're generating this excess return, at what point does the incremental interest rate challenge the companies? I would say as we sit here today, still really strong fundamental economic performance within the portfolios and not any signs of stress really making their way through as a result of the rate hike.